Thank you, Jeevan, and good morning to all the dignitaries and the delegates who are connected online for IBEX India 2021. And I feel privileged to address on the topic of post-pandemic banking, the key drivers of digital transformation. And I thank the organizers for inviting me and for enabling me to be a part of this August gathering. I find that, as usual, they have lined up interesting and intellectually stimulating sessions that are contextual and would also provide the participants a better insight. Ladies and gentlemen, the COVID pandemic made us realize that how fragile the human community is and how vulnerable we are. And it brought about a disruption on a global scale whose magnitude is difficult to measure and tough to fathom even today. And on the banking side, we have been facing this for the last 1 year, and still we are trying to find out how we can address these major problems which we faced. It had impacted all spheres of human activity, and banking was no exception to it. It delivered a global shock that disrupted both the supply side as well as the demand side in an interconnected world economy. The impact of the economic crisis delivered by COVID will test the operational resilience of all organizations and the robustness with which they can recover and rebound. These external disruptions do bring in new ways of looking at business handled hitherto and invent new means to respond to the challenges and usher in a new reality that would gain roots and going forward would become the new normal. The rapidness with which the organization adapts itself and the nimbleness with which the change is accepted across the organization defines the path to this new reality. Just as the title indicates, I have divided my address into two parts: post-pandemic banking, the responses from the government, from the regulator, and from the banks, and the digital transformation journey, the changes that have taken place during the last 1 year, and what are the changes which are in the offing as well, which would be more interesting to know from a financial institution perspective. As far as Indian Bank and a few other banks like Punjab National Bank, Canara Bank, and Union Bank of India are concerned, they also face the pangs of amalgamation of other banks along with the pandemic introduced stress and the strains associated with that. So it was not a one black swan even, it was a double black swan, I would say. One was this involved the harmonization of the products, processes, policies, human resources, technology of the other bank during the process of amalgamation during the last 1 year, apart from the COVID pandemic. Now, coming to the government, how it helped the financial institution, the government provided a fiscal boost to revive the economy and increase the expenditure and supported ventures by extending the emergency credit line guarantee scheme to the extent of about 3 lakh crore to MSMEs through collateral free loan with a 100% credit guarantee, and also not only to MSMEs but to other sectors which were badly affected, the 26 sectors which were identified by the Kamath committee as well. Extended about 20,000 crore through the subordinated debt to stressed MSMEs, 50,000 crores through equity infusion through fund of funds, and no global tenders for contracts up to 200 crores, production linked incentives up to about 1.45 lakh crore for 10 key sectors to boost manufacturing and to revive the economy. These are measures, monetary measures, which were brought under the Atmanirbhar package, which provided the much needed relief to the various sections of the industry and to assist them to tide over the crisis. And until and unless the industry is able to revive, the banking sector will be badly affected because of the failed payments which can cause because of the economy not reviving. The Reserve Bank, on its part, it reduced the repo rate by about 115 basis points to about 4% and reduced the CRR, the cash reserve ratio, also by 1 percentage point to 3%, and thereby releasing about 1.37 lakh crore. And the liquidity coverage ratio was also reduced to 80% so that it can infuse liquidity into the system and introduce the LTRO, that is the long-term repo options, and the targeted LTRO, apart from infusion of liquidity to NBFCs, HFCs, MFIs, and so on. Now, for loan repayments, the moratorium or the payment period was extended by 6 months from March to August 2020, and the moratorium was excluded while computing the 90-day NPA norm for the asset downgrade. Apart from implementing the above measures, the banks also introduced their own schemes to ensure that their customers are not badly affected during the pandemic, because we were conscious of the fact that there were job losses, there were disruptions, there were income generation was badly impacted and so on. Now we are witnessing a gradual recovery though the world is staring at a second wave, and during this recovery phase, the debt servicing capability of the borrowers are improving, and the sharp deterioration which we saw in the asset quality is not to that extent that was anticipated in a worst case scenario. When we did an analysis of the COVID impact, we took a baseline scenario, a severe scenario, and a worst case scenario. The stress was primarily witnessed in varying degrees across varying sectors. Travel, tourism, transportation, hospitality were the worst affected. Agriculture, telecommunication, and the pharmaceutical industries were the least affected, and they could handle on the work as usual. And certain industries which had not created an online infrastructure could not handle the crisis effectively, and they were struggling to meet the unprecedented demand which was caused during this COVID time. Could be education, because some of the educational institutions did not have the online facilities, and then the online food distribution did not have the online capabilities, so that they had to immediately ramp up the infrastructure to meet the increased demand. Now, how does the COVID impacted the financial sector, or particularly the banks per se? What were the changes which it brought, and how it changed the way in which banks were performing? First one was the remote workforce. It was something which prior to COVID, nobody would have thought that a banker can carry on his work without attending the office per se. But now banks have even thought of working from home and working collaboratively also. Now, work from home, which was primarily restricted to the IT sector, now it has come to the banks. Now, 1/3 of the workforce were operating from the home. Half of then later it became half, and then now slowly we found that there are certain sectors where that is the controlling offices which can still deliver effectively by working from home rather than to be physically present all through that in the bank. So when house became the office, there were multiple users like the husband, wife, the child, all competing for the same infrastructure when all of them were trying to be online. The audit functions also underwent a major change. Both the internal audit and the external audit adapted to the new norm of looking at data and the scanned images of the document, and carried out audit functions instead of visiting the branch network or for physical verification of information, which was normally the practice. The chartered accountants who were engaged, the central statutory auditors or the branch statutory auditors would visit the branches physically and verify. Now, most of them were sitting at their places, and we provided them the documents for them to verify and certify the information. Next was the acceleration of the digital, that I would come in the end. The reducing the cost and developing new operating models became the norm. Now, there were instances where we found that the branches were large in size. There was no need for such space in the bank branches. So we moved to smaller spaces, and then it also increased the focus on risk management. How do we manage risk? And the increased exposure to cyber risk became a major threat. When the situation is complex, the customers are switching to digital, and they are adapting to the digital, and which made the fraudsters also to exploit the situation and also make good money. I think the previous session was also on security in a digital world. I think that took greater emphasis, and we had to quickly ramp up and also monitor the digital traffic to ensure that the fraudsters do not gain advantage and threaten the trust which the customers had on banks. It also increased the collaboration with the fintech partners, improved the business continuity operations. Business continuity was given a major focus by the banks, and see that we are able to work from different areas. It not that one particular geography, but across geographies we were able to perform well. And also it increased the capital requirements primarily due to defaults in installment payments, rating downgrades of the borrowers, job losses affecting the payment cycles, resulting in NPAs post removal of the repayment holiday, because now there is an embargo on the repayment, the moratorium which has been given. Now, once that is lifted, we need to again assess how many of our customers would default. So therefore, banks were exposed to credit risk and operational risk during the last year and during the current year. And the recovery of the economy would only be a panacea for solving this particular issue. Bank branches, as I told you earlier, it was becoming smaller with lesser footfalls and therefore reduced rental, increasing the cost effectiveness of the operations. Now, let us see how once in a lifetime events that change the course or the way in which the banks have been operating or banking was carried out. Initially, one such event was the demonetization in November 2016. During that time, the lack of cash or reduced availability of cash for longer duration of time forced banks to rely on creating the adequate digital acceptance or the payment infrastructure. Banks increased the POS penetration, banks increased the ATMs, the quick response or the QR codes being offered to the merchants, the POS machines to the merchants. The POS machines in November 2016, if you see, it was around 15.9 lakhs. And now in January 21, it is close to around 57.40 lakhs. And similarly, the checks which were being cleared through the clearing houses across the country, which was around 9.35 crore checks, it came down to 5.96 crores, which is a positive development which we see. Now, if we consider the demonetization as having laid the platform and initiated the customers to choose digital as an alternative, now COVID has deepened the penetration of the digital and also initiated the uninitiated towards the digital. Like the senior citizens were taking to digital payments, seniors and housewives were taking to digital because of the COVID situation where they were not able to go out. And that is a positive sign for banks, where we found that many of the people who were not hitherto using digital products and services have opted for such products and services. And when we consider the digital push or the thrust given by COVID, it is not only the financial sector, but through the fintechs which have been driving this, but also we should view the edutech as well as the agri-tech, all ushering in positive or digital initiatives that would blossom and mature in the years ahead. It would not be just incremental change which we are looking at, but we are seeing a radical shift that would be witnessing in the years ahead. On the financial side, if we see that we have the liabilities or the deposits which we have seen banks were offering, and this was available for more than 5 or 6 years, I would say, that banks were facilitating the customers to open their accounts, their liabilities, that is a savings account or the fixed deposit accounts, close their fixed deposit accounts online. This was prevalent for more than 4-5 years across various banks. And either it was facilitated through internet banking or mobile banking, and the UPI also came in and chipped in terms of fund transfers and the remittances per se. But now what we are seeing post-COVID is on the asset side. There is a revolution which is happening on the asset side, where we find that in the life cycle of a loan product, that is the submission of the application, the due diligence, the verification, appraisal, documentation, disbursement. This is the entire life cycle of a loan product. And this entire life cycle is turning digital, which means that we are now able to get a digital profile of the customer without having to physically meet the customer, which is a major shift which we have seen. And that is thanks to COVID, I would say. Now, when a customer is permitted to apply digitally and for a loan product, and then when he applies that and he furnishes certain information, which could be in the form of a PAN card or an Aadhaar card, which is again verified digitally, we ensure that it is the same person who is applying for that particular loan. And when he gives the GST number, we are able to log into the GST site and then get to know what is the turnover which he has done, and whether the loan amount what he is seeking is commensurate with the turnover which he has achieved during the previous 6 months or 8 months and so on. And then the major thing what I would say is that the appraisal can be done digitally, because it is the banks which have the data, and then we can appraise that as to what extent of loan can be given. But the major thing which has happened now is the documentation part. Documentation was physical, where a customer has to physically visit the branch, sign the document, stamp the documents, and then provide that to the banker. Now we find that NESL, it has facilitated the digital document execution, which means that it comprises of two parts. One is the digital stamping and the digital execution through a digital signature of the customer, which means that a customer need not visit a physical branch, but he can execute the documents as if he is executing a physical document. And then once the document gets executed and we verify the digital credentials of that customer, we are able to go for the disbursement, which can again happen digitally, which means that it's nothing but a movement of funds to his account, and then he is able to withdraw the money or use it for the purpose for which he had applied for a loan. So this major shift is something which has revolutionized the way in which a banker looks at an asset product. And this going forward will be the norm, which starts with the personal loans now, and then the small retail loans, which will get extended to credit cards, which will get extended to MSME products, and going forward to the other types of loans, salaried loans, and so on. So this means that a customer need not visit a branch. He can just get himself through the internet or through the mobile application, apply for a loan. The verification is done digitally. The appraisal is done digitally. The documentation is done digitally. And ultimately, the disbursement also happens digitally. And there's one more new intervention which has happened during the last 1 year, which is still not yet gained roots. But I think in the next maybe 6 months or 1 year, it will be prevalent, which is the account aggregator model, where a customer of one bank can give his consent to another bank. And with the consent, the account aggregator who sits in the middle can fetch the statement of accounts from that bank. And we are able to see the credit history and then take a call as to whether he is credit worthy, and then we can disburse the loan. The credit information companies like CIBIL, Equifax, Experian, all these are able to provide information digitally, so that we are able to assess as to what is the extent of loans which the borrower has got, what is the repayment which he is currently doing for the various loans which is availed, and then I can take a call using the account aggregator, find out what is the amount of salary which he is getting credited to his account, or what is the turnover in his account, and then take a view of that. Now, the fintechs also have collaborated with banks. I would definitely take a major step that these fintechs have played a crucial role in bridging the gap. This collaboration with the fintechs only enabled banks to seamlessly integrate their monolith core banking systems with their operations, and then see that we are able to fetch the details on demand and see that whether we are able to online analyze all that information. Similarly, on the regulatory side also, we have been seeing a lot of interventions which has helped banks. One was the formalization of the video KYC. It was not that somebody has to physically come, give the proof of address, proof of residence, and then sign in the presence of the bank official. Now, video KYC is also accepted as a norm for taking in or onboarding a customer. Similarly, the CKYC is another major step, I would say, that because when a customer has to maintain accounts with multiple banks, he doesn't have to give all the details repeatedly. Once he is given to a particular bank and it's registered in the CKYC, the CKYC number itself would facilitate the customer to avail the loan from other banks as well. So these are some of the things which has helped banks. And going forward, I think in the next 1 year, we will see the prevalence of the DigiLocker. Once we find that the digital document getting executed, we will get into the DigiLocker, where we can store the documents, and then the requester can request that information and see for himself what exactly are the various documents which is there. It could be that insurance policies, when it gets dematerialized, it can also form a part of the DigiLocker. Similarly, the other intervention I would say is the major intervention is the Udyami registration certificate for MSMEs. Now, an MSME can be called as an MSME not just by the turnover or by the investment in plant and machinery, but he has to get online URC, that is a Udyami registration certificate, which only categorizes him as a micro, medium, or a small enterprise, which means that he can apply digitally, get that certificate, and then he can categorize himself as an MSME. Similarly, we find that blockchains, artificial intelligence, all this will come into place, because when we talk of digital, I think in the previous session, you would have heard about the security features. Now we have what is that the governor in his last monetary address also, the Reserve Bank of India governor, has told that digital currency also, there is an internal working group of the RBI which is working on digital currency, which means that the whole cycle, the life cycle of a financial transaction can be done digitally. So coming to the next part of it is the security. In a digital world, security needs to be assessed, and a growing digital footprint means that greater susceptibility for the customers, and particularly those who are uninitiated towards this, the computerization, particularly those who are past their 50s or 60s. So therefore, there is a need for greater security for the digital transactions. It is always observed that crime turns digital first. Crime has turned digital. We have seen several cases of frauds which are happening, and the gullible losing money. So therefore, security should not be an afterthought, but it should be unobtrusively made available at the time of implementation itself, so that it's not an overkill, but it's always an underlying factor which protects the customers as well as the banks, and the trust which the customer places on the bank is not lost. And here only I would find that the fraud risk management systems, the artificial intelligence would play, and then we can keep a profile of the customers as to what is a normal pattern of transactions, and if there is a variation to the pattern, we can immediately ping the customer or contact the customer, get an OTP, confirm that it is a genuine transaction, and then allow it. Otherwise, we can decline those transactions, and these are in the evolving phase. And we find that there is a push from the government also to create a digital district where at least one transaction is done by the customers digitally, and there is all the customers do at least one transaction digitally. And going forward, I think we would be finding that this penetration will be increasing in India. In conclusion, I would say that the previous decade for banking was the decade of core banking, and now I can safely assume that this decade will be the decade of digital banking, and we will be witnessing changes either by the banks themselves or through fintechs partnerships for digital transformation in the way in which we carry out banking transactions. And the regulatory push for digitization should come in the form of digitizing land records, property details, tax and statutory compliances, so that the financial institutions can access these information online seamlessly, and also create a charge or remove a charge on the properties, so that part also can be done in a seamless manner. Just, of course, CERSA is playing a role, but I think we need to have some push on that front as well. And the government and the regulator can play definitely a catalytic role to ensure that there is a shift, and we would be witnessing greater products and services on the digital front in the days ahead. And with this, I conclude my address, and I wish the organizers that they would be having very interesting sessions, and I feel privileged to be a part of this session of IBEX 2021.